The Business Review brings you top financial news developments, influencing financial markets, international currencies, commodities, global commerce, tourism, and other economic events from around the globe.
Cuba's President Miguel Diaz-Canel said the country's already cash-strapped economy shrank 11% in 2020 due to the pandemic and tougher U.S. sanctions, adding the government had thwarted attempts to exploit this monetary weakness to create social unrest and topple it. Addressing a year-end session of the communist-run country's parliament, Diaz-Canel said that the state-run economy would grow 6 to 7% next year. Earlier, the economy minister, Alejandro Gil, had said it would take the next 2 years for it to recover from this year's sharp contraction. The government's estimate was even more dire than that of the United Nations Economic Commission for Latin America and the Caribbean, which this week predicted an 8.5% contraction for Cuba compared to a 7.7% regional decline. COVID-19 obliged us to modify all our estimates, Diaz-Canel said, referring to an initial forecast for 1% growth this year. There will be no growth, he said, but rather a contraction of 11%. The economy declined, he added, but didn't stop. Cuba's imports were more than 50% of its fuel, food, and many other vital inputs, and this decline, coming on top of a 15% drop in 2019, has resulted in scarcity and long lines for even the most basic products, from food and medicines to fuel. The president said the government had thwarted attempts to destroy the country's revolution by capitalizing on this moment of economic weakness. Over the past week, state-run media have run shows on what they say are attempts directed and financed by the United States and Cuban Americans abroad to create unrest on the island, like attacks on state shops. Government critics say it is trying to undermine authentic discontent among Cubans and requests for greater civil liberties, underscored by a rare rights protest by artists outside the Culture Ministry late last month. Diaz-Canel spoke of challenges ahead, pointing to the monetary reform taking place from January, including a steep devaluation in a bid to dynamize the economy.
U.S. senators expressed an optimistic tone as they enter the final stages of crafting a $900 billion COVID-19 aid bill that is expected to include $600 to $700 stimulus checks and extended unemployment benefits. Ahead of Friday deadline, Senate Majority Leader Mitch McConnell said that an agreement appears to be close at hand. Senate Democratic Leader Chuck Schumer said everyone is committed to achieving a result and they will not leave until they get the job done. The $900 billion price tag for the package would be paid for by $600 billion in repurposed funds from other parts of the budget and $300 billion in new money, according to a senator privy to the discussions. The negotiations come at a key moment for a U.S. economy clearly weakening after an initial rebound from a recession triggered by the pandemic earlier this year. Consumer spending buoyed through the summer and early fall by more than $3 trillion in federal assistance has hit a wall as new lockdowns limit business activity and keep people home. Democratic President-elect Joe Biden said the stimulus package was encouraging, but more aid would be needed. Commerce Department data showed retail sales fell unexpectedly sharply in November, with consumer outlays on goods and services showing softness across the board. The Federal Reserve promised to keep funneling cash into financial markets further into the future to bolster the economy, even as policymakers' outlook for next year improved following the rollout of a coronavirus vaccine.
Gustavo Delgado walks every day from his home in La Boca, a hard-scrambled neighborhood of Buenos Aires, to a nearby community pantry to find the only food that he and his family are sure to be able to eat that day. Office cleaner Delgado, aged 52, lost his job after the economy he worked for went belly up due to COVID-19. He's unable to find a new job so far, and he lives in a small house with his wife and granddaughter. They are 3 months behind on rent. Argentina's recession, which began in 2018 due to investors' distrust in the policies of the former President Mauricio Macri, worsened in 2020 due to COVID-19. President Alberto Fernandez, who took office about a year ago, locked the country down in March. Many of those restrictions have been lifted, but the virus continues to spread, with more than 41,365 fatalities so far. Poverty, according to the Argentine Catholic University, increased in the third quarter to 44.2% of Argentines' 40.8% registered in the country a year earlier. On Thursday, the National Statistics Body, INDEC, will release unemployment rate for July to September period. According to the latest survey of analysts by the central bank, the economy will shrink by 10.9% this year before rebounding by 4.8% in 2021.
China's insurance regulator announced that the country will increase the supply of long-term assets for the insurance industry to bolster the real economy. By the end of October of 2020, insurance funds had raised 18 trillion yuan for the real economy through bonds, stocks, and non-public market investments. During this time, insurance asset management companies directly meet the financing needs of major infrastructure projects through debt financing and equity financing, with the total scale of insurance asset management products reaching 3.8 trillion yuan or $580 billion. As a next step, the China Banking and Insurance Regulatory Commission say they will introduce a number of measures to bolster long-term financing support for national strategic projects and enterprises development. Yuan Xucheng, Director of Insurance Fund Supervision Department at CBIRC, said the country will support insurance funds to hold banks' existing assets related to financial products, encourage relevant departments to enrich medium and long-term investment varieties in the bond market, and develop trading markets for long-term investment assets.
Some Libyans worry how the new price of the dollar might impact traders and citizens after the central bank agreed to a devalued exchange rate across the country of 4.48 dinars to the dollar from January the 3rd. The board was holding a full meeting for the first time in 5 years after dividing as Libya split between warring western and eastern factions. Unifying both the Central Bank of Libya and the exchange rate are key goals of the economic track in the United Nations peacemaking process. One Libyan citizen said that sometimes solving a problem is a problem in itself. The state must take these into consideration, especially because of the liquidity crisis. CBL is based in the Libyan capital. It's the seat of the internationally recognized Government of National Accord, the GNA. This eastern branch is based in Benghazi, home of Commander Khalifa Haftar's Libyan National Army. In territory controlled by the GNA, the CBL has an official exchange rate of $1 to 1.34 dinars. The black market rate in western areas was $1 to 5.35 dinars on Wednesday. In 2018, the GNA imposed a fee of 183% on hard currency transactions, effectively devaluing the dinar at the official rate of $1 to 3.9 dinars to bridge part of the gap to the black market rate. As the Tripoli CBL has an effective monopoly on foreign exchange transactions, the Eastern authorities had to conduct business at a higher rate, while the GNA was exempt from that fee. The gap between the official and the black market rates distorted Libya's oil-dependent economy, aggravating a liquidity crisis and causing corruption as armed groups with access to dollars at official rates made money from import scams.
This brings us to the end of this episode of the Business Review. We hope to see you again tomorrow with news of stock markets, economic conferences, commodities, currencies, regional and international financial news, and much more.